What's going on, guys? My name is Brad and this is the bottom line. If you have no idea what a balance sheet is, or you have heard of it but don't know exactly how it works, then this is the video for you. A balance sheet is one of the most important financial statements that will help to give you an idea of the financial health of a company. So, what does a balance sheet tell you? The first thing it's going to tell you is to smash that like and subscribe button if you haven't already. Now, once you've done that, it's going to break down the business into three main components: assets, liabilities, and shareholders' equity. So assets are basically what the company owns. Liabilities are what the company owes, so it's obligations to others. And shareholders' equity is essentially the book value of the company, much different than the market value. And if you were to take all the assets and pay off the liabilities, the remaining assets would equal the shareholders' equity. So what makes up shareholders' equity is essentially the money that is received when shares are issued or any retained earnings within the company. So there is an equation you are going to want to remember: that's assets equals liabilities plus shareholders' equity. And what that kind of shows is that all assets are financed or backed by either debt or equity. And one more thing to consider: a balance sheet is a snapshot of the business at a specific point in time. This is different than, say, a cash flow statement or an income statement, which are for given periods of time. Okay, so here is an example. This is just a textbook problem balance sheet, but it paints things out nice and simple. In the future, we will use actual balance sheets from earnings reports, but for people just starting, those have a lot of other accounts and the formatting can be a little more confusing. So let me just get my pen. Okay. All right. So first thing I'll point out is this. Oh God, that was supposed to be a line. So you see it says as at March 31st, 2012. So that's what I meant by it being for a specific point in time. Okay. So if we split down the middle, we have assets on the left, liabilities, and shareholders' equity on the right. So what did we say? We said assets equals liabilities plus shareholders' equity. And this component is liabilities, the rest is equity. So this is the equation: A equals L plus S E. Okay, so what you'll notice is the balances of each side are 300. They balance. Okay, so let's look at what you will find on each side of the balance sheet. Looking at assets, we have cash, that's just the bank balance. Accounts receivable, so money owed to the business from other people or businesses. Inventory, so for product-based businesses, they value their inventory. Now, companies have to be careful not to overvalue their inventory because this can lead to problems down the road. Prepaid expenses are just things you pay for up front, so insurance, rent sometimes. And the sum of all those will give you your current assets. And current assets are basically things that can be easily liquidated and turned into cash within a year or less. The rest: vehicles, equipment, land, buildings, investments, and intangible goods like patents and goodwill, which is just the extra you pay when acquiring a company. Those are all your fixed assets. So your current assets plus your fixed assets give you total assets of 300. Looking at the other side, for liabilities, current liabilities are made up of accounts payable, so money you owe to other people or companies, credit card debt, bank credit lines, accrued expenses, taxes payable, and the current part of any long-term debt you have. So all those added up are your current liabilities. And long-term liabilities are just anything due a year or longer out. So long-term notes, bank debt, mortgages, things like that. So the sum of your current liabilities, your long-term liabilities will give you your total liabilities of 200. And then shareholders equity. So you can see money, equity received from issuing common shares, preferred shares, just with voting rights, and retained earnings within the company. So if you had the income statement, the net income number less any dividends would be transferred over to the retained earnings balance. And the sum of all those would give you your total shareholders equity, which would, when added to total liabilities, give you your 300 to balance with the total assets. So let's look at examples of how different business actions would affect the balance sheet. So let's say for number one, we collected, forgive my writing, collected, let's say 5,000 in accounts receivable. All right. Okay, so if you are collecting 5,000 of accounts receivable, that is going to decrease that balance to 50. So what happens when you collect on accounts receivable? Your cash balance is going to go up, and that would turn to 10. So notice nothing happens on the total assets. It balances out. 5 was taken out of accounts receivable and added to cash. So let's say second scenario, we pay down, let's say $1,000, pay $1,000 in credit card debt. Boom. Okay, so what happens if you pay down credit card debt? Well, it decreases, so by 1,000, and that would become 4. And just so you know, all these numbers are in thousands, so that's what I mean when I say that. And then what happens when you pay down credit card debt? Well, that's coming out of your cash balance, so that goes to 9. Okay, well, both the total assets and total liabilities and shareholders equity sides are going to decrease by 1. That's a 2, because you lost 1,000 in cash and you decreased your obligation to credit card companies by 1,000. So 299 is your new balance on each side. Last, let's say we pay $1,000 in dividends. Okay, so where do dividends come from? Well, the cash balance. So that's going to go to 8, and that's going to decrease your net assets by 1,000, so 298. And then what happens on the other side? Well, you are going to pull those out of retained earnings. So that becomes 49, and your net balance would be 298. Your cash is decreasing, and your retained earnings is decreasing by 1, and your new balancing number is 298 on each side. So in future videos, we will go over the ratios that you can calculate from the numbers on this financial statement, and those are going to give you a picture of the health of the company, how able are they to meet obligations, things of that nature. Comment below, guys, if this was useful or any questions you have moving forward. Please smash that like and subscribe button if you enjoyed the video and found it useful. Thanks for tuning in, and I will catch you guys in the next one.